So this is one of the very interesting sessions which we would be having in the morning. The asset management companies and many of us know that in last 10 years, from the 10 lakh crore assets, now these companies are handling roughly around 55 lakh crore worth assets now. And many of the gentlemen sitting here are the champions and representing the champion companies who have made it. Especially when the foreign players, they went out because they couldn't invest into the distribution networks, and which they have painfully, created in the country, and now they are leveraging many of those benefits. So when Prime Minister is talking about, see, I am a Delhi wala, so there is always a political tadka to my conversations. When Prime Minister is talking about his third tenure, and he is talking about Abki Baar, 400 Par, there are a lot of euphoria in the markets, not only in the stock markets but also amongst the investors. I want to understand from all four of you that what sort of sentiments do you see in the markets? What sort of preparations the players are doing, especially when Prime Minister is talking that now many of the bold steps will be taken to push the markets as well as the investments. And he has already given a brief roadmap that in next 10 years there will be a $10 trillion economy, and in next 25 years he wants to make a $35 trillion economy. And that will not be possible before, without the mutual funds and asset management companies. They are upping the game. So maybe, Srinivasanji, you can start and help us in understand that, what sort of things you foresee. And if you can help us in understanding that with the, especially, State Bank of India has a deep distribution network. How do you think that that network can help in accelerating the growth?
The growth of the asset management industry is what you're asking?
Industry as well as, eventually to the country. No?
So we are growing at a hectic pace. And right now we have a problem of more money coming in and not enough stocks to buy, which is pumping up valuations. Yeah. I'm saying we are growing at a hectic pace already. We're getting a lot of flows. And right now we have a problem of too much money coming in, chasing too few ideas out there, which is pumping up valuations. Right now it looks like this growth will continue because when the investor looks at the rear view mirror, he's clearly making a lot of money. So I don't think we need to do anything extra. We're getting more than what we're asking for from an asset management company.
But do you think that there has to be more portfolio expansion, more more type of assets need to come into the fold? Because still there are very limited exposure is there. So do you think that more diversification is required?
In terms of asset classes,
Asset
you mean?
classes.
So we have set up an alternates division. So we do long short funds. At some point we will get into private equity, though it's a different ball game altogether. I think that is happening. But right now the flow is into public markets, which is the mutual fund where you have a tax benefit. So it's clearly a lot more attractive.
Thakur Saab, if I can come to you, you help us in understanding, since SBI is a big player, but how do you see this expansion happening? You are part of the growth story of the country. So help us in understanding that.
Sure. So in the previous sessions we spoke about the Jam Trinity, Jan Dhan Aadhaar Mobile, and the first thing is obviously a bank account where it's the first step of financial inclusion. I think the second step is happening as we speak, where accounts are being opened for mutual funds as well as for insurance companies. So after JAM, probably there is D, which is a DMAT account, and you spoke about distribution and how that has been a challenge. So that obviously on-ground distribution helps a lot, but what we have seen is some of the newer players are able to leverage the technology infrastructure and really bring a lot of players into the fold. So people like Zerodha, people like Grow, Kuvera, Paytm Money, T-Money, lots of players have come in and really this number of unique investors in the industry, which has gone to 4.5 crores. I think that rise has been driven by a lot of these online discount brokers who have brought more investors to the fold. Completely take the point that Srini spoke about, that probably flows are running a bit ahead of the fundraising. So given that a lot of capital expenditure is needed to grow the country, maybe a lot of fundraising will be required to keep the valuations in balance going forward.
Montiji, this $10 trillion, dream is very big. So what sort of preparation do you think that your industry need to make, because many of the things, $10 trillion also means that country needs to grow at 12% CAGR. So that will also happen only if, markets also complement, plus, the growth also comes from the, bottom of the pyramid. So what sort of preparation do you think your industry needs to make that thing happen?
See, from our perspective, in this industry, there are two players. The fund managers, you see two incredible ones to my right, and the investor. These are the two relevant people in our industry. The job of all of us is to communicate transparently and truthfully between the two. That is the fiduciary nature of this business. When you talked about, Rajiv talked about 4.5 crore investors, let me remind you, before COVID, it was just 2.3. That would mean some 20-25 years of mutual fund industry resulted in 2.3 crore folios. Post-COVID, just four years, we added 2 crore more, or maybe more than that. So the financialization of assets is happening. Now, whether 10 trillion will happen on a certain date or a little later is a reality. It will happen someday or the other. But what's happening at the underlying is India definitely has long-term investors making very short-term investments. Last year, the equity AUM grew by around 8 lakh crores. And you said 10 years ago it was just 10 lakh crore industry. Out of that 8 lakh crores, just 1.6 lakh crores is net sales. The rest is what the fund managers have got to the table. That's something which we have to think, whether investors are actually marrying their investment journey to the 10 trillion journey. They, like Shini rightly said, are completely rare view investors. I mean, and when you're looking at 40% of flows going to small caps, it is brash return chasing. So there a lot of work has to be done as to how personal finance has to grow, and there you all play a big role in communicating to the investor of shifting to a far more longer term approach. And hence, see, the market got 1,60,000 crores from us, market has run up. But the investor has been switching from one fund house to the other, probably one scheme to the other, and that big gap of investment return or investor return. That's the bigger challenge. From our side, there are just two infrastructures that is needed. Like Srini rightly said, and Rajiv kind of echoed, there is more money coming in than we can manage. At Mirae Asset, we've been infamous for stopping flows many a times, and we continue to do that because you have to take in money which you can manage. So that's the main focus, to increase the infrastructure of the fund management team. That's point number one. If you don't have the infrastructure to manage the money, you should not be taking money. Second is to increase the infrastructure of servicing these clients. And then that a lot of tech play will happen. If these two simultaneously start growing up to encompass the money that is coming on, we can manage any other flow. Otherwise, it will lead to some other places.
So when you say that, the inflow is more and outflow is less, so is it more structural issue, or do you think that, the enough asset classes are not there where investments can happen?
So irrespective of what the money will come in, bulk of the money will remain in the core places. Bulk of the money will remain in the core form of your, pool, which is large companies, solid companies. Invariably, that is where the big plays will happen. Now, whether this play will be active or passive, time will tell. I don't think adding any asset class will create anything further. There are enough stories and more in the market. Now, after the last 10, 15 years, one is wondering whether equity is a better performance than gold based today. So all those things have to be realized at an investor level through a substantial personal finance knowledge, either through you or our large distribution base. And that's where the story has to unfold. I don't think adding any new asset class will result in. All those ideas are already there. And there are more than those ideas which are not attracting any money. Bulk of the money remains in the core, boring, solid ideas.
Mr. Sunil, what is your view? This is a very peculiar situation that inflow is much more and outflow is limited. This requires a lot of innovation. So how do you, see this scenario?
So first of all, your statement that inflows are more than outflows, you need to moderate it with taking SIP out of the picture. Today, SIPs have touched almost 20,000 crores. You take away the SIP flows, the outflows are more than the inflows. On lump sums, right, people are booking profits and taking out money. It's SIP flow which has sustained the industry, right? And that, I would say, is the best thing to have happened, right? Because when customers are buying through regular systematic way, right, the volatility in the market becomes an aid to them rather than a panic to them, right? Rupee cost averaging comes to. So as the new investors who come in, we've had almost doubled the number of new investors. As they come in through the SIP route, right, they then don't panic. Whereas if we saw what happened in 2006 and 7, there was the same rapid rise in the stock markets. In 6 months, from 2007 July to December, markets went from 14,000 to 21,000 Sensex. When the GFC happened, for the next 2 years, 3 years, industry struggled to get people to come back into it. Because that time it was a NFO-driven, lump sum driven. What's different now is that the entire distribution committee, MFDs and the banks, have been making people to come in systematically. And that's where I would say is the best thing to happen, right? Because if this sustains the flow, and we can dream of a day when your SIP book can be 100,000 crores a month, from 20,000 crores, 3 years, 4 years down the line. That will be the real sustainable one. Second is the money which is still coming in, right? If you see mutual fund as a proportion of bank deposits was in 2010 about 14%, today it's 27%. So there is money, it is being diverted from the banking system to this. But in my view, that's still a lot of greed money. It is not retirement planning money. It is not the fundamental reason to eat in equity is that that's the only way to beat inflation. And I think we have a long way to go to educate people, because when there's a correction in the market, right, how will people behave? The same people today. So just go back to December 22. All of us experts sitting here, go back into your own media, take any media house, say, what was the expectation for the year 2023? They all said fixed income is the best. 8% return is reasonably assured in fixed income. Equities may or may not give. End of the year, what happened? Large caps delivered 24%, mid caps delivered 60%, small caps delivered almost 70%. So reading that market view and this flows, right, happened only after those returns became apparent. So more than 50% of the SIP book is coming into small and mid caps, right? Now, the key point from my view of the industry is that we need to sell large caps to investors as less volatile products with the intention of building a retirement corpus. Fundamentally, the simplification of the product. Because today, this whole looking at the past returns and putting more money, it's an easy sell to a customer to go and show the small cap returns and get him to put. The industry is doing good by not taking it in lump sum and putting it into SIPs. Distributors, I think, have done a fantastic job there. But even there's the risk that, you talked about the Delhi and you will talk politics, right? Take one thing, right? 70,000 crores of money came in from FIIs in the month of December, right? After December 3rd. The 3 months prior to that, FIIs were net sellers in India. What happened on December 3rd was the assembly election results gave them a confidence about this government returning to power, right? Now, is it all 70,000 crores come for 10-year money? There are hedge funds who will put money for 6 months. Mr. Narendra Modi comes back to power, he will book his profits. Be prepared for volatility. Don't think that all this money is lasting there forever. So, in a volatile situation, right, they may sell large caps. But fund managers, when they see large caps correcting, will divert their flexi cap money from small cap to large cap. And that could lead to correction in small cap. How is the investor going to behave there? How is the distributor going to handle that investor? These are the larger issues that we need to make sure. And I think that sensibly marketing retirement planning products, children's education products, making sure those asset allocations are largely in the large cap space, getting a less volatile, decent inflation beating, FD beating on a post-tax return is what we as an industry need to move the country's population, because 4.5 crore in a 140 crore population. So the glass is not even 10% full. So I think the right selling, according to me, I hate to say the word mis-selling, but just pushing products based on, customers are buying products on past returns. Industry is happy to sell based on past returns. All that money is coming. You take your BSE or NSE 500 index. 500 stocks, 74% of the index is in large caps. That means 100 stocks account for 74% of the market cap, 400 stocks account for only 25% of the market cap. So even a small amount of liquidity through these SIPs coming into the small cap and mid cap, plus of course your PMSs and your retail buying micro caps, as Mr. Nilesh said, that's pushed up that. That's all, except for the SIP book, the rest of could be hot money. So I think that we need to make sure for the growth, sustainable growth of our industry, right, that we sell a broad-based range of products with an adequate tilt towards large cap oriented products so that the volatility is less, and even large caps will comfortably beat inflation, and as long as the current tax regime of 10% continues, they will get double the fixed deposit returns. So I think long-term sustainable growth has to be on the right selling and the right pitching of the product to the investors, especially the new ones who are coming in. The balance 136 crores who are yet to come and taste the capital markets.
Srini, he has dealt with the froth issue to some bit, but I want to prick your mind, when we read 75,000, the benchmark number at Sensex, there are certain discounts which we see that, many of the analysts are flagging also, that Fed rate cut, they are discounting it. Then political stability, they are discounting. Then they are discounting that oil prices will stay stable or lesser than $90 at present. Do you think that the Indian markets are mature enough, or they have attained that level that once the burnout comes, they'll be able to sustain it and continue with the growth story? Or do you think that certain things need to be corrected before that burnout comes? What is your view?
No, it's not a question of maturity. Markets are cyclical. So if expectations, if actuals are lower than expectations, then the markets will fall. So you will see that cyclicality. It's not a question of maturity. US market is mature, but US market falls. Unless you're talking of whether the market will factor in long-term growth, I'm sure it will factor in long-term growth.
But sir, but the thing is that how much
So Modi doesn't come in with the market fall. Yes, it will. That's very obvious. If Modi doesn't come in for a third term, will the markets fall? It will. It's not a question of maturity. It's a question of what the market is expecting and what will eventually happen.
But the thing is that even if Modi comes, the market is bound to do corrections, because I believe that hedging is happening.
Markets do not move on events. Market moves based on expectations of those events. So whatever events are factored in, you will not get that price appreciation. The real question is, you don't know what is factored in. How do you figure out what is the expectation in the market? You can ask me, Rajiv, a couple of others, and they'll tell you something, but we are not the market.
Okay. So, Thakurji, if I can come to you, if you can help us in understanding that this froth thing, how much do you think is froth and how much you think is the real beer in this glass?
So the question of what investors will do, or are they mature enough, jumping into that question. See, we haven't seen a sustained downturn or low level for, I would think, quite a while now. We had a period from 1992 to 2003 where markets went nowhere and gave negative returns. Post 2003, buy the dip has worked each and every time. Any 10-20% correction, you jumped in and you made money within 3 years. How will investors behave in a sustained downturn is guesswork. I don't think anyone has an answer. People get excited about EPFO money. I'm sure if EPFO makes negative returns on equities for 5 years, there will be questions in the parliament, what business do we have putting retirement money into equities? So that is a fundamental question which no one has answer to. How much is froth? How much is reality? I think that question is somewhat tricky because barring 92, every subsequent bull market, there have been pockets of exuberance and pockets of reasonable valuations or undervaluation. Late 90s, new economy was frothy, old economy was cheap. 2007, real estate, infra, commodities were frothy. IT services, FMCG, pharma were reasonably fine. 2017, froth in small and mid caps, others were cheap. So it's a complicated question. We largely, as active managers, have to figure out 20, 25, 30 companies where we find opportunity and invest in those. Broadly, I would agree with what Mr. Nilesha said in the previous session. Large caps are more or less okay. The smaller the market cap and the less liquid the company, the more the chances of it being frothy in the current market.
Thakkaji, what is your view? Monteji, what is your view into this conversation?
See, I think a lot of wealth is not created in three discussions. First is market all-time high. Second is when is the next correction. Third, now the new term is froth. The reason people come to mutual funds is they will take care of these three. You do your asset allocation. What is happening is nothing, not that anybody is not aware of what it is. If you are going to put 40% of your money in smaller companies, there are genuine issues. There is nothing wrong with those companies. The issue is when you put 40% of the money. Right? That's the bigger issue. And that's where the discussion has to revolve around. Discussions have to revolve around what is the right asset allocation rather than whether market is an all-time high. It has been all-time high for all my career. I got married in 96, gold was 5,400. Right? It continued to grow. I got married at a time when markets were all-time low. So, does the NAV stop after you redeem? It does not. Right? Will India stop growing? Will it stop growing? It won't. Now, it depends on how you view. Whether you view the Sensex at 74,000 or you look at India at 7.4 trillion will define how you behave. That is where the discussion should. I don't know whether there is froth in the market, clearly. No, if somebody knew, they wouldn't be salaried employees, is a reality. Right? So, if the story is intact, then all you do is take the ride with the story. Now, if you want to time the story, then the discussions of froth will come in.
And do you also think that it is the right time to increase the float for many of the companies? The capital floats, is it the right time for them also? And especially, when we see that, PSUs, this government is talking about taking the market routes. And this is the right time to basically, increase their or decrease the government equities into those companies. Is this the right time?
This froth is being discussed because of ownership of free float, right? Yeah. And increase of free float will always be welcomed by all of us. The risk is how much free float you own, right? At our end, we don't cross 3 to 4% of free float, never. Irrespective of what is our valuation of that company or what we feel of that company. We are cognizant of that always. So we will always, and that's the job of the regulator to kind of see to it that float always increases, liquidity increases. It's a market factor. But if you see systematically, it's been growing over the period of time, even from the lower companies.
Sunilji, what is your view? Is it a good time for companies at least to look at the options of increasing the capital float? Take the market money in, especially, the way the markets are behaving right now?
See, the first thing is, I want to say is that this word froth, right? It's inevitable that the markets, right, go through cycles. It's like the industry has to go through cycles because capacity addition can happen only in bulk, whereas consumption happens linearly. So inevitably there will be capacity excess, capacity shortfall. So like that, the markets, because they are not driven by the linear nominal GDP growth, but by liquidity flows coming in and out, there will always be periods of excessive valuations followed by periods of correction, right? So these periods of froth is the bad word, right? Everybody is trying to say, is there froth, and scare investors away or come in the public domain, right? Now, like Swaroop said correctly, the fund manager's job to figure out is that froth is coming because of there's a future discounting happening, because the markets entirely deal in the future. Is that a verifiable one? Is there a downside risk, a margin of safety? That's their job. But if froth were not there, this industry's penetration would not have happened. Lassi, bina froth ke piyoge kya? See, why I'm saying this, the capital markets go through this word irrational exuberance. I'm surprised you haven't brought it up. That's this famous word. What happened after he said irrational? Markets went up even more. So the point is that there are experts sitting there who managed people's money, right? Now the point is for people, if they're coming in seeing a 68% return last 1 year in small cap and expecting that next year will be 68%. That's the challenge. Why are you in the equity markets? You want to beat inflation, beat FD returns. So if you make 20% next year in small caps, you shouldn't turn out and say, "Arey yaar, khali 20% hi bane." Right? So that's why I'm saying, see, the froth, however, plays an important role. This penetration would not have happened if those exciting returns were not there in the hands of mutual fund distributors to go and talk to the customers, see the potential. So let's not discount this froth, because it's an inevitable part of the market cycle. In the good cycle, how well we capture it and how well we do right selling. Don't just use the past returns and say future mein hi hoga, but use that to say this is a good investment prospect. So that's one. So from that point of view, then coming to your question, which is about one of the reasons why there is froth in pockets is because the promoters are holding too much of the equity with themselves, right? Now, why are they not listing it more? Why are they not diluting it? Because they don't see a use for the money. Our fundamental problem today is that our capacity utilization, after recovering from COVID's 60% to 75%, has got stuck there. The infra cycle is being driven by government spending on roads and infrastructure, by FDI coming into PLI schemes and some factories and others being created. But domestic private sector is not building fresh capacity. So as the consumption story moves based on the per capita GDP growth, I believe that promoters will use the capital markets to raise money to finance their capex program. So it will happen that this froth will get diluted by the increase of the free float. So it's a part of our life. So we just have to smartly manage the money, and that's the job of the AMC industry, to manage, not to say no to the customer. My worry about this froth thing is that you're trying to scare away customers. No. Take it in the right way. If your small cap fund you feel you can't deploy, you put a pause. But take the money in your large cap. So we have to take the money in the right way, sell the funds in the right way as long-term inflation beaters, and then deploy it in the right way, right? So this is the mix. For example, in a small cap fund, you can put 35% in large caps, right? SEBI allows you that. So can you handle that money by putting it more into large caps, where all of us agree that it's not as frothy or obviously as the mid and small cap. So that's the job with the experts. Leave it to them. But I don't want this froth to lead to investors being shying away from the markets. Markets will, over the long term, and Swaroop's point about lifetime high. Every lifetime high investment after 5 years has delivered inflation beating returns. Take it from me. The lifetime high should never be a reason for you not to invest in the market. Keep your horizon to that period of 5 years, 7 years, linked to your goals. So I think goal-based asset allocation, these are far more important questions for us to deal with people than about this.
Thank you, Sahilji. You know, I have been telling everybody that I am greedy. So because of my greed, we have, exceeded the time. But I'm really thankful that all 4 of you have increased my knowledge base. And I'm sure the same feeling will be there in the audience. I thank you really from my bottom of the heart. And I'm really sorry that because, the time is up and we are running behind little schedule, I will not be able to, take the questions from the audience. Maybe the gentlemen are around, so maybe later on you can have those questions. Sona.